Most traders think technical analysis means predicting the future. That is already the first mistake. Technical analysis is not about guessing where price might go because you feel smart, because the news sounds bullish, or because some expert on the internet says the market is about to explode. Technical analysis is about something much simpler. It is about reading what the market is already revealing through price behavior. And that matters because most losing traders do the opposite. They start with opinion. They start with bias. They start with what they want price to do. But the market does not care what you want. It only shows one thing that matters: where buyers and sellers are actually doing business. Technical analysis asks a very different question from fundamental analysis. Fundamental analysis usually asks, what should this asset be worth? Technical analysis asks, what is the market actually doing right now? That difference is huge, because a market can stay far away from what people think is fair value for a very long time. A stock can look cheap and keep falling. A stock can look expensive and keep rising. A currency can look overextended and still trend harder. A market can ignore logic longer than most traders can stay patient. That is why technical analysis starts from price. Not because price is magical, not because charts predict the future, but because price is where all decisions meet. Every fear, every expectation, every rumor, every reaction, every urgent buy, every panic sell, every institutional adjustment, every retail mistake, all of that gets compressed into one visible thing: price movement. That is why price matters. Now here is where many beginners get confused. They hear this and think technical analysis means ignore everything except candles. Not exactly. The real point is this: whatever information matters, the market eventually expresses it through behavior. Technical analysis does not require you to know every reason first. It requires you to observe the effect. And that is a major shift in thinking, because beginners are usually trained to believe they need to know the full explanation before they can act. Why did price move? What caused this candle? What does the news mean? What are institutions thinking? But the chart often moves before the explanation becomes obvious to the public. This is why price can move first and the story comes later. And if you wait until the story feels comfortable, a lot of the move is already gone. That leads us into the first major model you need. Here is the simplified framework. Price reveals pressure. Pressure creates trend. Trend continues until the balance changes. That is the whole backbone. Let me repeat that. Price reveals pressure. Pressure creates trend. Trend continues until the balance changes. If buyers are consistently more aggressive, price pushes upward. If sellers are consistently more aggressive, price pushes downward. If neither side has clear control, price moves sideways, becomes messy, and traps people. So when you look at a chart, you're not supposed to ask, what do I hope happens next? You're supposed to ask, who is in control here? Is that control strengthening, weakening, or failing? That is the beginning of chart logic. Now, let us go one layer deeper. A lot of traders think a trend is just price moving in one direction. That is too shallow. A trend is not just direction. A trend is organized behavior. In an uptrend, price does not usually go up in a straight line. It pushes up, pulls back, holds, then continues. That tells you buyers are still willing to defend higher ground. In a downtrend, price does not usually crash in one line forever. It drops, bounces, fails, then drops again. That tells you sellers are still controlling rallies. So the chart is not just drawing random shapes. It is showing you how one side responds after the other side makes a move. That is why reaction matters. The reaction after an impulse tells you more than the impulse itself. A sharp bullish move can look impressive. But if the next pullback completely erases it, that strength was not stable. A bearish drop can look scary. But if it gets rejected immediately and price reclaims the level, sellers may not have real control. This is where technical analysis becomes useful, not because it gives certainty, but because it helps you judge the quality of behavior. And that is what real traders do. They are not hunting certainty. They are reading behavior and making probability decisions. That leads into market reality. The market is not a clean classroom. It is not a perfect textbook pattern generator. It is not obligated to reward your understanding. This is where many new traders get hurt. They learn a concept, then they expect the market to perform the concept perfectly. For example, they learn higher highs and higher lows mean uptrend. Correct. But then they see one higher high and immediately declare a bull trend. Or they see one breakout and assume continuation is guaranteed. Or they see one pullback and buy too early without asking whether support is actually holding. This is the difference between memorizing patterns and understanding chart logic. Chart logic means asking, what is price proving? Not, what pattern do I want to see? That is a massive difference. Because once you become pattern hungry, you start forcing trades. You start labeling every market structure as something tradable. You start seeing setups where there is actually only noise. And that is one of the biggest beginner mistakes. So let us make this practical. When looking at a chart, your job is not to decorate it with opinions. Your job is to read three things. 1. Direction. 2. Structure. 3. Response. Direction asks, is price generally moving up, down, or sideways? Structure asks, are swings clean, organized, and consistent, or are they broken and sloppy? Response asks, what happens at important areas? Does price hold, reject, accelerate, fail? That alone will already make you more dangerous than most beginners. Now let us talk about common mistakes, because this is where most traders destroy otherwise good ideas. Mistake number 1, confusing explanation with execution. A trader says, I understand why this market should go up. But understanding a reason is not the same as having a trade. You could be right about the idea and still get destroyed by the timing. You could be right fundamentally and wrong technically. And in trading, wrong timing still costs money. Mistake number 2, thinking technical analysis means prediction. No, technical analysis is not. I know the future. It is. I can read the current condition and prepare for likely paths. That difference protects you. Prediction makes traders rigid. Reading makes traders adaptive. The rigid trader says, price must go here. The adaptive trader says, if price holds this structure, continuation is likely. If it fails, my idea is wrong. That is professional thinking. Mistake number 3, entering because a chart looks exciting. A lot of bad trades come from emotional charts. Fast move, big candle, strong breakout. Looks powerful. But what matters is not excitement. What matters is whether price is behaving in a way that supports continuation. A breakout without follow-through is weak. A push without structure is unstable. Momentum without confirmation often becomes a trap. Mistake number 4, ignoring the difference between trend and noise. Not every move deserves your attention. Some charts are trending. Some charts are rotating. Some charts are just punishing impatience. If the chart has no clear structure, your first responsibility is not to trade it better. It is to stop pretending it is clear. Mistake number 5, believing one signal is enough. One candle is not enough. One breakout is not enough. One opinion is not enough. Technical analysis works better when multiple pieces of behavior point in the same direction. Structure, reaction, location, momentum, confirmation. You do not need 20 indicators, but you do need enough evidence. Here is a simple do and do not framework. Do trade when a market shows clear direction and clean structure. Do trade when the area you're watching has already shown reaction. Do wait for proof that buyers or sellers are actually defending their position. Do build your trade idea around invalidation. Meaning, what would prove me wrong? Do focus on quality over frequency. Now the don'ts. Do not trade because you are bored. Do not trade because the chart moved fast and you feel left out. Do not buy just because something looks cheap after falling. Do not sell just because something looks too high after rising. Do not confuse a single candle with a full market argument. Do not enter before the market has shown its hand. That last one is important. Most beginners lose because they keep trying to be first. But technical analysis is not a race to predict first. It is a method for reading better. And usually, waiting for confirmation saves more money than early guessing makes. So what is confirmation? Confirmation is evidence that the behavior you expected is actually happening. If you are bullish, confirmation might look like this. Price holds a support area. Buyers respond with strength. The next pullback stays shallow, and price reclaims or breaks a recent swing level. That is confirmation. If you are bearish, confirmation might look like this. Price rejects from resistance. Bounces fail quickly. Sellers press back down, and the market breaks support instead of recovering it. That is confirmation. Notice what is missing here. Certainty. Confirmation is not certainty. It is alignment. It is the market saying, yes, this idea has evidence behind it. That is enough. Now let us talk about checklist thinking. A lot of bad decisions disappear when you force yourself to slow down and ask better questions before entering. Here is a simple checklist you can use. First, what is the market condition? Trending up, trending down, or ranging? Second, is the structure clean enough to read? Third, where is the important area? Support, resistance, breakout level, failed level. Fourth, how did price behave there? Hold, reject, stall, accelerate, fake out. Fifth, is there confirmation or am I still guessing? Sixth, what would invalidate this idea? Seventh, am I taking this trade because it is good or because I want action? That last question is one of the most powerful in trading because a lot of retail trading has nothing to do with analysis. It is emotional hunger wearing an analytical mask. Now, let us bring everything together. Technical analysis is not the art of drawing lines and pretending the future is visible. It is the discipline of reading market behavior. It starts from a simple belief. Price is the final meeting point of all opinions, all expectations, all fear, and all aggression. From there, you study whether one side is gaining control. You study whether that control is stable. You study whether the market is continuing, weakening, or reversing. That is why technical analysis works best for traders who can stay honest. Because the chart does not reward ego. It rewards observation. The more you try to impose your opinion on the market, the harder the market becomes to read. The more you let the market speak first, the more structure starts to appear. And that is really the turning point. Technical analysis is not about being smarter than the market. It is about becoming more obedient to what the market is already showing. That is the skill, not prediction, not opinion, not excitement. Observation, interpretation, execution.